Hello, ladies and gentlemen. This is your host, the tutor, Kingsley Ejiofor, bringing the final lap of this module. The module is themed Business Decision Analysis, and this final course we are going to deal decisively with today is titled Quantitative Analysis of Business Decisions in the New Normal. It will be a wrap of all we have been learning in this series. So the entire module, is made up of 5 courses, and this is the last lap of the course. Quantitative Analysis of Business Decisions in the New Normal. I remain Kingsley Ejiofor. Let's proceed. So the crux of quantitative analysis of business decisions is to summarize all which you have been learning into decision tree. That will help us to summarize all we have been learning. That will help us to put all parts together to form a holistic view on how business decisions analysis are being conducted. That will help us to drive in-depth analytical methodology to get results. Leave the big grammar, it's just a simple method. Just follow me and we will get the points flowing shortly. The decision tree. Decision tree is the anchor of most decision analysis because most management decision makers can easily relate with both the quantitative and the qualitative nature of a decision tree. A decision tree is tabular, is pictorial, it has a graphical view, it's what you can see, it's what you can relate with, it's what you can comfortably assimilate. A decision tree adds the much needed clarity in understanding and utilization of the decision analysis problem. Any business or management decision challenges can be expressed in a decision table. It can also be expressed on a decision tree. It can also be expressed using a histogram. It can also be expressed using tables. I love decision tree because it shows both some other factors which other forms of decision explanations cannot show. So if I tabulate decision results and data on an Excel spreadsheet or another similar method of expressing points, data on a table, the table expression of data does not carry the feeling of the decision maker. It does not show what you feel, what your gut is telling you. But a decision tree carries that atom of feeling. It carries that gut. It carries an expression of your probability nature, knowing that these are your personal opinions concerned, with respect to the decision to be made, given the historical data or current data available at hand. You can combine your knowledge, intellectual assimilation, compared with physical evidences and your feeling, your gut, to make a decision. Yes, I can fully tell you that, most organizations' decisions are logically driven. However, there's a part where the gut feeling comes in, where you can sense something. You cannot really express or explain that in-depthly to another person, but you can feel something within you. The decision tree gives you the room to factor in that your gut feeling with the real facts, with the real logic, with the real analysis, all put together will give you a perfect and holistic business decision. Okay. A decision tree eliminates and it also emanates with a single decision node, and it develops into branches of possible outcomes. So there are core pillars that makes decision tree a decision tree. There are some pillars that you cannot have a successful decision tree without putting those pillars in place. The same way you cannot build a house and expect the house to stand the test of time without putting the pillars, the columns in place. So these pillars we want to mention right now, these columns we want to break down right now, are the core pillars, are the crux that makes a decision tree effective. First is the node. This is a point in a decision tree diagram where lines intersect and attractions activated. I repeat, lines intersect on the node and attraction is activated on the node. So a node is a very sensitive part of a decision tree because it activates interest of both the decision makers and those who will review the decision. So the nodes have two subsectors or two subcategories. These two subsectors of the node is what we call the decision node and the chance node. What is a decision node? This is a point where the decision maker or the decision makers decide which decision alternative to follow. Have this at the back of your mind. At every decision node, a decision must be made. I repeat, at every decision node, a decision must be made. A decision node is a point by which you decide on what to do. So a concrete decision must be taken at every decision node, and a decision tree have series of decision nodes, and we will use a practical example to explain. Yes, there are some simpler forms of decision tree where the decision to be made is not cumbersome or complex, that you can have one decision node. Then that decision node helps you to analyze all the alternatives available at that decision node after having factored in the chance nodes, and you can have one single decision to be made. So the decision node can be represented by a small square. We'll use pictorial view to explain. If you have been following us on the course, you can understand this. If you have not been following us, I will personally recommend you go and search the other 4 courses on this module which we have treated earlier on. Go and dissect them, study them in depthly, and it will give you a full holistic background in memory that will help you to be able to assimilate what we are saying in total. The decision node can be represented by a small square, and the decision node do not have any associated probability. All associated probabilities can be traced only at the chance node. I'm giving you the pillars. In every decision tree, decision probabilities of occurrence, the feelings, the guts, can only be found at the chance nodes. These are the chances where things have probability of occurrence. But at the node where you have to make a decision, there's no chance, there's no probability. It's either you do this or you don't. Note, decision must, M-U-S-T in capital letters, decision must be made at the decision node. Now, the next pillar of decision tree we want to talk about right now is the chance node. The chance node, which we categorized earlier on as a subsector of the node, is the point that shows the associated probabilities or risks that have chances of affecting the output of a decision. The decision node requires a decision to be made, and the chance node carries risk, carries the probabilities, and all must be factored in for a decision to be made at the decision node. Remember that we said earlier on in other previous courses that the chance node has a probability, a minimum probability of 0 and a maximum probability of 1. The probabilities at the chance node cannot be more than 1. 1 means certainty that expected alternative have a highest probability of occurrence, and 0 means that particular alternative have the least possible chance of occurrence. So why deciding on which path to follow on a chance node, you factor in the probabilities, you factor in the risk, you factor in the alternatives available at the chance node, and that will help you in analyzing. Now we will put in practical explanation and we put all these pillars to test. The chance node can be represented by a small circle. Remember, the decision node is represented by a square, the chance node is represented by a circle. So don't mix both. The decision node is represented by a square, the chance node is represented by a circle. And the probability fractions must sum to 1. So a chance node can have 2, 3, 4, 5, 6, as many probabilities as possible, as many risks as possible, factored in the chance node to be able to follow a particular alternative. But for a decision to be made at the decision node, at the chance node level, all the probabilities, 5, 6, 7, as many as they are, have to all be factored in the analysis. All the probabilities at the chance node must sum to 1. Cannot be more than 1. Must always sum to 1 on a positive basis. The probability on a chance node cannot be. A chance node cannot have one alternative. I repeat, a chance node cannot have one alternative. Reason being, at every chance node means there's a chance for an event to occur or not to occur. So you can see 2 have already applied here. So something can either happen or not happen. So if you take this decision alternative, things can turn out the way you expect them to turn out, or things cannot turn out the way you expect them to turn out. So there are always at least a minimum of 2 alternatives at every chance node, and it can have up to 3, 4, 5, 6, 7, as many alternatives as possible on a chance node, with all the associated probabilities factored in the alternatives. And you have to factor in the alternatives, factor in their respective payoffs, factor in their respective probabilities to be able to conclude the expected monetary value on that chance node. Okay. Then, ending towards the end of the pillar of decision analysis of a decision tree, you have what we call the end node. End node is the point indicating where the final decision, where the final outcome, where the final position that the decision maker have finally chosen to make is being selected. It is represented by a small square box, mostly located at the extreme left of a decision tree. We'll show that in an example. So a decision node which terminates at the end node is showing you that at this point, this is the final echelon of decision. We've made the decision, we've capped it all, we've looked into all the costs, we've looked into all the risk, we've looked into all the alternatives, we've looked into all the revenues, we've factored in all that needs to be factored in, and finally, this is our decision. So the crux of the decision tree analysis is the end node. It is important to note that all nodes on a decision tree must be specified as either a decision node or a chance node, using the specified images: square for the decision node and circle for the chance nodes. If these nodes are not identified, it will be very, very difficult for a decision maker or for a reviewer to be able to make a worthy decision from the decision tree. It will be very, very cumbersome for another person who is looking at your decision tree to be able to arrive at the same decision you arrived at if the decision nodes and the chance node are not clearly, represented using their respective diagrams. If the decision tree is not properly labeled, it will be also become a cumbersome task for another person to be able to look at the decision you have made see the reason, the logic behind the decision, and be able to arrive at the same point with you. The decision alternatives emanating from decision nodes and the corresponding chance alternatives emanating from chance nodes must be clearly labeled on the decision tree. All alternatives, all points, all diagrams, all factors of a decision tree must be labeled. You're labeling it because another person have to review what you have done either currently or in the future. So a decision have been made on a specific organizational challenges. Now, a decade down the line, a new management is in place and similar challenge raises its ugly head. Somebody have to make a decision. If they make reference to the decision which have been made earlier on, will you specify all the factors on the decision tree clearly so that another person who was not in the management team when such decisions are being made can look at the tree, can look at the points, can look at your explanation and be able to understand what was being done, how it was done, and how the decisions have been arrived? Helping them to have a clue on how to solve their own current challenges at hand. So a decision tree ought to be clearly labeled, indicating the decisions to be made and the associated chances of occurrence. Fundamentals of decision tree. For decision tree with many branches, some decision trees have a few branches, some have many branches, depending on how complex the decision to be made is. So, decision tree with many branches comprising two or more decision and chance node, it is recommended that a separate computation of the conditional values at the terminal point be made before specifying these values on the tree. I will explain. So, for every payoff is located at the extreme right end of a decision tree. So, for every payoff, you have the values at the terminal payoff. For every payoff, you have the values at the terminal payoff. So, let me use a typical example to put this in the right perspective. So, this is a decision node, okay, and this is a chance node. Remember, I said a chance node is represented by a circle, a decision node is represented by a square. Then there are decision alternatives. So this is a decision alternative, and the decision alternative is emanating from the decision node. Okay, and at the chance node level, we also have alternatives. That the event expected to occur at the chance node have the chance of occurring or not occurring, and with its associated probabilities of occurrence based on facts on ground. Now, at this point, this is the terminal point, this is the extreme point. This is where payoffs are being tabulated. Payoffs are figures, numbers that are being computed after the revenue from that decision has been factored in, the associated costs from that decision have been factored in, the feeling, the risk weighted averages have been factored in, and a decision, an expected payoff, an expected monetary value, an expected output is finally being derived. Now, those outputs will now be written as payoffs at this terminal points. So each alternative have its estimated payoff. So as many alternatives as you have as many payoffs as possible. Now, what the last point where we read is being is pointing out is that for a decision tree, you don't do your calculations of your payoffs where you have the tree. So you go to a separate sheet, which will all be attached together with the decision tree. You go to the separate sheet, that is where you do your computation of your payoffs. So the payoffs computation is not done on the front sheet where a decision tree is being drawn. Why? The tree will be cumbersome. It will be difficult for another person who was not there when that analysis is being made to understand what is being made. But if you itemize, label clearly your decision tree and pick the points of labeling and explain your computational values on the next page and clearly label it, the person who is reviewing it, or person who is going to view the decision made, or person who is going to analyze that decision to either concur or disagree, can be able to pick the points made clearly. Okay. All right. So that's exactly what we are trying to say here. So all computation must be done in a separate sheet. Also, in solving a decision tree, we commence calculations from the terminal points. So we start from the known and we head towards the unknown. We start from the data we have at hand, from the expected revenue, from the costs we have at hand, from what we have at hand. We now start from there to start working towards what we are not certain about. So we walk from the known to the unknown. That is a core principle, that's a core fundamental in decision tree analysis. Now, why walking from the known to the known, we obey a principle. The terminal points, the payoffs. Okay, another way of calling the payoffs, you can say the terminal points. So the payoffs, the chance nodes, and the decision node should be numbered alphabetically. Should be numbered alphabetically, not numerically, but alphabetically. Why are we not using numerical in itemizing, in labeling the decision node, the chance node, the terminal points? Because our expected values calculated on the decision tree are numerical. So we cannot use another numbers to label the decision node and the chance nodes. It will be confusing. So we use alphabets in our labeling of the decision tree. So I prefer, personally, I love using capital letters in my alphabetical, labeling of the decision tree. It brings clarity to the decision analysis calculation and enable reviewers, decision makers, to easily understand the modalities involved in the decision making. Okay. This is a typical representation of a decision tree. All the points we have mentioned earlier on are all captured on this diagram. Now, if you look at the end here, it is clearly stated that this decision tree summarizes all we have been learning on this course. Now, every decision tree must have at the base, where my cursor is pointing at the base, you identify the decision you have made. So at the base, you clearly state the decision you have made. Now, I did not clearly state the decision here because this is for example. This is for explanation. So that's why I stated here that this decision tree summarizes all we have been learning on this course. So for you who is going to make a decision, if you're making a decision, you're going to state clearly that this summarizes the decisions, and this and this and this are the decision arrived after looking at the decision tree. Now let's break this tree down. First, this is what we call the end note. If you look at this tree, you can see that this tree have more than one decision node. Okay, you see a decision node here, you see another decision node here. It's clearly labeled. Okay, remember we said an end node is the decision node at the extreme left terminal. That is indicating the final decision made. And remember the last fundamental we explained said that every decision node, chance nodes, should be labeled using alphabetical labeling. So if you look at this end node, you can see it's labeled A. You can look at this chance node. This chance node represented with a circle is labeled B. The next chance node is labeled C. The next chance node is labeled D. The next decision node is labeled E. So all the nodes in this decision tree are clearly labeled. So where I am going to do computational analysis on the next page, I can clearly calculate specifying A is equal to. So when you come to the tree, you look at the A alphabet, you know what the numbers I have indicated in the next page where the numbers are being gotten from. So you can see where 39,789 US dollars, how it's been accomplished, it will be stated in the computation. Now, at the terminal end left, which is the end node, there's two chances here. Now, the first chance is decision alternative to do something, and the second chance is another decision alternative to do the next option, depending on the decision to be made, depending on the challenge facing the decision makers. Now, after a decision, the first decision alternative, you have what is called the payoff. The payoff is the expected revenue, expected profit from the calculation after the entire revenue, the entire costs, entire risk have all been factored in. So total revenue minus total costs will give you this figure. Now, you come down to the next alternative. You can see this alternative is already marked X. Why is it marked X? Now, it's marked X because if you look at the payoff is 34,200 USD. But the next alternative to the same decision is having 39,780 USD. Now, 39,780 USD is far bigger than 34,200 USD. So this decision alternative that will give me a higher return on my investment is a more valued decision alternative. Remember that we have risks, probabilities which have been factored in. This having this figure 39,780 USD, having the risk accompanied in its computation is termed the risk weighted value, and that becomes the final value at the end note, indicating a decision which the decision maker has made. So assuming this decision is intentionalized and this decision is not intentionalized, you can already see the corresponding figures associated with it, which decision alternative, and that will help you to make the final decision. Now, on this risk-weighted value and on this chance node, you can comfortably see the probabilities of occurrence. So at this chance node, there's a possible outcome of this 50% of this chance occurring, another 50% of that chance occurring. We will also use a real life company challenge, okay, where we will look at the case study, analyze the case study, and solve the case study using the decision tree model. Well, I'm trying to put this perspective so that we can all understand how this is being done, finally get the full grasp of it before we start dealing with hard case studies. Okay, the possible outcome. So on the first possible outcome here, there's a chance that that possible outcome can actually come to pass or will not. So the 40% probability of it coming to pass and the 60% probability of it not coming to pass, meaning that the high likelihood that it will not come to pass. But however, if you look at the monetary value of it not coming to pass, it's going to give you 67 USD, $200, 67,200 USD, and the 60% of it occurring will give you 25,800 USD. Now you look at the figures, you look at the values, you see it's looking interesting. But this chance node being different from the decision node, remember at the decision node we look at the expected monetary values. So we looked at this value, And we looked at that value and we chose the highest value. So 39,780 USD and 34,200 USD. We looked at two of them and we saw that 39,780 USD is higher, and we chose that at our endpoint. But on the chance node, it's a different ballgame. When the possible outcome here on the payoff B is having 67,200 USD, but on the alternative respect to it is having 25,800 USD. We are not going to take 67,200 USD because it's bigger than 25,800 USD. No. We can do that if this is a chance, if this is a decision node. But for a chance node, we're not going to do that. Remember, a chance node factors in feeling. A chance node factors in the risks. Now, there's a 60% probability of this occurring, which is the risk and the feelings factored in, and there's a 40% chance here. So those risks, those feelings must be factored in the monetary value to be able to have the final value. So we have a risk-weighted value, which is a value that have factored in the probabilities of occurrence. So this 42,360 USD is arrived at by doing 67,200 USD times 0.40 plus 25,800 USD times 0.60. By the time you sum the two multiplications, you have 42,360 USD. Now, this is a risk-weighted figure, and this is expected monetary value. Why is it expected monetary value? The decision alternative had been factored in on this decision node. The first decision alternative, second, and third. And we looked at the monetary values. Now, the monetary values covers the expected profit, total profit, and the total cost. So when a total cost is eliminated from the total expected profit, you have a net value. Now that is your payoff. So for the first decision at C, you have a payoff of 25,800 USD. And for the payoff at D, you have 12,900 USD. And for the payoff at E, we have 12,900 USD. And when we factor in C, D, and E payoffs, we have the highest payoff here, which is 25,800 USD. Now, that becomes the highest expected monetary value and is placed at the decision node E. Now, that expected monetary value being risk weighted, being multiplied by the associated probability 0.6 plus the 0.4 probability multiplied by the highest expected value here, which is 67,200 USD, will give us a netted risk-weighted value, which is 42,360 USD. That's how this factor and figure is being accomplished. Now, coming to the second chance node downwards here, which has a probability of occurrence of 50%, which is 0.5. The chance node D has three possible outcomes. So there's a first possible outcome, which is additional alternative. The first possible outcome has a 0.4 probability of occurrence. Second possible outcome has a 0.4 possible probability of occurrence, and the third possible outcome has a 0.2 probability of occurrence. Now remember, we said that the sum total of all the probabilities at a chance node must sum to 1. So if we add 0.4 plus 0.4 plus 0.2 will give us 1. That is the sum total of the chance nodes, the sum total of all the probabilities at the chance node. So you must always look at that. If you look at this second chance node at chance node C, if you sum the entire probability 0.40 and 0.60, if you add it together, it will give you 1. Second chance node, if you look at the chance node B, summing all the associated probabilities at chance node B will give you 0.50 plus 0.50, that will give you 1. So all the probabilities associated at all chance nodes must always sum to 1. It's a rule which must be followed always. Okay, now this risk weighted value at 7,200 USD at chance node D is arrived at by using payoff F. Payoff F is the total revenue minus total cost, is giving us this value, 42,000 USD. Now, the chance node D, the risk weighted value, which is 37,200 USD, is arrived at by doing 42,000 USD multiplied by 0.4 plus 36,000 USD multiplied by 0.4 plus 30,000 USD multiplied by 0.2. When you sum the computation of these three values, you have a risk-weighted value of 37,200 USD. That is how this value here is being arrived at. So this is the summary of explanation of a decision tree. This is how a decision tree appears. Some can be more complex and more cumbersome than this. Okay, but we chose this just to explain the core principles, explain the core patterns to us, so we can follow this and have a clear view of what a decision tree is, how it's being calculated, how it's being arrived at, and how it's being used to make a decision. So the expected decision to be taken at the end here has factored in all the total revenue, all the total cost, all the risk, all the probabilities, all the feelings and guts, and has aided the decision maker in arriving at the decision. So you have a more concretized decision which you can stand by and keeping your head high above the waters and saying, I have made the decision, or we have made this decision, and this is our result. And anybody who looks at your decision, follows your computation, have looked at this, can say of a truth, this person knows what he or she is doing, or this team knows what they are doing, or this organization knows what they are doing. So this is a core factor which must be clearly understood and utilized effectively. Summary: there are steps in decision making. These steps must be followed always. So step 1, you want to make a decision, it's complex, it's not clear, you don't know what to do. First is to clearly define the problem at hand. Ask yourself first, what is the problem at hand? What is the challenge you're trying to solve? What exactly it is? So from the cumbersome stories surrounding the whole decision to be made, itemize the points, the core points that need to be addressed. So clearly define the problem at hand. That's first. Second is list the available decision alternatives or choices. For every decision to be made, there must be alternatives. If there's no alternative, then there's no decision to be made. If it's just only one alternative, then there's no need to make any decision. Just follow the alternative. But most cases, a decision that needs to be made have more than one alternative. So there are 2, 3, 4, 5 different alternatives available. So list out all the alternatives. Alternative A, do this. Alternative B, do this. Alternative C, do this. Alternative, do that. Maintain this, adjust this, follow this, and all that. By the time you list out all the alternatives, it's clear to you that these are the possible ways that this thing can either go. It can either go this way, or go this way, or go this way, or go this way. It cannot go any other way outside these 3 or 4 or 5 alternatives. Now, you have mirrored down from the cumbersome nature, you have mirrored down to the possible alternatives there. Next is to identify, out of these decision alternatives, what is the possible outcome? What is the probability of each of these alternatives occurring? So if it is this A, is this A likely going to occur? Looking at the environment, looking at the topography, looking at the culture, looking at the value system, looking at things, the data, historical data, can this really occur? Can this not occur? What is historical data talking about? How has this been handled in the fall? Following 5 years, 10 years, 20 years down the line, historical data, how did it occur? So, what is the probability that this will really, manifest? At what degree will it really manifest? So, by the time you itemize all the possible outcomes from the decision alternatives, you are mirroring down your decision. Next is to evaluate your payoff, your profit. You factor in the associated cost. Remember, while doing your cost analysis, you don't remove anything. From consultancy fee has to be factored in, time value of money has to be factored in, logistics has to be factored in, overhead has to be factored in, every associated cost, production costs, every associated cost must be factored in. Then you factor in the revenue. What revenue are we expecting from this? Okay, based on the current market trend, based on the current costs of things, based on the current prices of things, how much are we expecting at the end of this? So you itemize the profit using your payoff system. So by the time you have arrived at a profit at the terminal end of your analysis, you have factored in your revenue, factored in your cost, and we've arrived at a profit or a loss. It's not always that a decision ends at profit. Some decisions analysis, you see some alternatives end at a loss, some alternatives end at a profit, and some having a higher value of profit. So each alternative, after clear analysis, tells you what to do. Now, second to the last step here is select the appropriate mathematical decision model. Okay, so here we use the expected value criterion. Remember, I said it can be expected monetary value, expected gold value, expected. So depending on what are you expecting, that determines the value you attach to it. And you run your analysis using that. I've shown you how to arrive at the values at every chance node. You have to multiply the probabilities by your payoff. And I've also shown you how to arrive at the values at the decision node. The values at the chance nodes. I've shown you how to arrive at those values, like in D here. I said use the terminal end payoff 42,000 USD to multiply the probability 0.4 plus addition. The next terminal end 36,000 USD to multiply the second probability of occurrence 0.4 plus using the last terminal end value 30,000 USD to multiply the last probability of occurrence, which is 0.2. By the time you multiply and add your values together, you should have 37,200 USD. Now, that is how you arrive at the risk-weighted values at your chance nodes. So for all chance nodes, the associated probabilities must be factored in the computation. And in your decision node, you just have to make a decision. Which of the decision alternative have the higher value? The higher value can be the higher profit, the higher value can be a lower loss. So assuming each of the decision alternatives is giving you a loss, and all your decision alternatives are all giving losses. So which of them minimizes your loss? Which of the alternative have the lower loss? The alternative with the lower loss becomes the best alternative to choose. So in this case, we're having profits. So the alternative with the highest profit becomes the right alternative to choose. The last point here says apply the model and make your decision. Time value of money. $1 in year 2000, it's not the same value with $1 in the year 2030. The time value of money have been factored in. There's a depreciation in the value of the money. The purchasing power of that money has been devalued over time. So in projecting operations, in projecting, forecasting the future of business, you have to factor in time value of money. So time value of money have two major applications. One is in investment and returns, which have to do with future forecast, future analysis. So when you're dealing with future, you have to factor in time value of money. Second application of time value of money is in capital applications. Capital application is when you are making a capital intensive expenditure. For instance, you're buying a machinery, okay, you're buying automobile. So such capital projects are being depreciated over time. Depending on what their lifespan is, you depreciate them and factor in the depreciation in your time value of money. That will also be factored in the decision analysis before your payoff is being arrived at. So you're not just going to make profit from the business. While calculating your costs, you calculate in the depreciation of the items. You calculate in the amortization involved. You factor in the task. Okay? So the time value of money factors in total cost, total profit, depreciation, amortization, tax, and net profit. Now, for you to analyze a business adequately, you must factor in depreciation. You must factor in amortization. You must factor in cost. You must factor in task. You must factor in profit before you arrive at your net profit or net value. These are highly important. They distinguish sustainable organizations from non-sustainable brands. They distinguish decision makers from non-sustainable decision makers. They distinguish high flyers in a corporate organization from non-high flyers. This is one of the core reasons why companies liquidate and other companies are waxing strong. Those who know what to do and those who don't know what to do are being clearly identified over time. Conclusion. Decision tree is a viable tool in quantitative analysis of business decisions because its values are clearly represented diagrammatically on the tree, and it can be interpreted correctly by another decision maker with little or no explanation given. So you can draw a decision tree, analyze it, arrive at a decision, and pass it on to somebody else who was not there when you started analysis, who was not there when you started your figures and your view, and the person may not even need to ask you any question. The person can review your decision tree independently and see your points and see your decision made and know whether it's correct or not. Everything is clear on a decision tree. There's nothing hidden on it. Historical data or information is needed in this analysis. Hence, its results is not impromptu. So a decision tree is not what you rush into. You rush into a decision tree right now, in 5-10 minutes, you're done with the decision tree and come up. No. A decision tree is not what you do impromptu. A decision tree is what you set down and analyze. Because you have to factor in real data. You have to factor in reality. You have to factor in profit. You have to factor in costs. You have to factor in depreciation. You have to factor in profitability. You have to factor in probabilities of occurrence. A lot are involved in analyzing a decision tree. That is why it is highly used in top decision making. Also, sustainable organizations globally use this method to analyze business decisions, especially when huge funds are involved. You cannot have huge funds at stake and you are just analyzing with your head, only your head. No matter how genius you are, there's a possibility there's a lot of things you cannot capture with your head. You need to put paper to pen. I need to sit down and analyze. And decision tree is one of the good methods that will help you to make the right decisions. I've written a book called Management Codes, Quantitative and Qualitative Analysis of Business Decisions, written by Kingsley Ejiofor. This book has in-depth details of a decision tree. It has 5 real-life case studies of local organizations, of multinational organizations of organizations that have lasted up to 100 years, organizations that are century, that have lasted up to a century. They are being analyzed in this book. Their case studies, the analysis of the case studies are contained in this book. This book has a full, clear explanation of time value of money. It shows how to tabulate time value of money, how to put it into practical use, and how to use it in making decisions. This book factors in all the risk known by humanity, all the risks known by humanity to affect businesses, to affect individuals, to affect sustainability of corporate entities. They're all being factored in this book. And all the risks are being analyzed, and the solution to all the risks are clearly stated in this book. This book, Management Codes, is not just a story, it's not just a book, it's a book that was born out of demand from my students. There are demands, high demand. These things we're learning from you are in depth. They've learned a lot of things, and they said, please, can you document this on a book and give us the book to help us solve these problems? I recommend this book to all senior managers, all decision makers, all business executives, all owners of corporate organizations. I recommend this book to all MBA students. This book will make a difference in your business and personal decision analysis. You can mail me at mailkeymarks@gmail.com and you have a copy of the book. Thank you. If you have any question, if you have any clarity, the email address here provided. You can mail in your questions, you mail in your suggestion, making your contributions, whatever it is. Communicate, share, open up. Let's analyze together. Thank you for making out time to follow this course to the end. This is the end of this module. We'll commence another module briefly. Thank you, and thank you, and thank you. It's nice always having you all around. Nice always being with you all. Thank you.